Thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We get into what's impacting mortgage rates on a daily basis, whether it might be something from headline news or something in regards to economic data that was just reported, or something geopolitical, or hey, even sometimes markets have mood swings and those sentiments change. So sometimes good news could be bad news, and vice versa. We're here to kind of help you guide you through these times where let you know what's impacting those rates on any given day, and then try to at least give you a little forecast, at least a week ahead, what might be an impact, at least economic data wise, or sometimes even headline news that could potentially affect rates on any given day, what might be the catalyst for that week. Today happens to be this week, which we'll touch on in a second. But a little bit about myself is my name is Mike again, and I do work with the National Lender. I'm a loan officer, and we're here to answer any questions you might have, whether it's about mortgage programs available or rates or the process. We're here to help you guys. So if you guys would like to refinance or purchase, we would love to be able to earn your business, so please reach out. In the meantime, we'll jump right into this. As I was indicating, we do have the economic calendar we'll start off with. I'm going to use a different chart here because it gives a little bit more information than what I have right there. We'll start off with employment costs for the third quarter. The last quarter came in at 0.7% increase. Forecast for the third quarter was supposed to be 0.9%, and the third quarter initial one came in at 1.3%. So as you can see here, this is kind of the breakdown between wages and benefits. And you can see that wages came in a little bit higher than the benefits, weighed a little bit more for the cost of employment costs. These are obviously inflationary data, so this is something we do need to keep our eyes on because that could increase inflation. As employment costs rise, they're going to pass those costs on to the consumers in their products or services. Let's move on here. We got personal income. We see a 0.2% increase for the month of August, and forecast is showing for a 0.2% decrease for the month of September. However, it decreased even further by 1% for personal income here. Now, here's the biggie. This is the one we've been looking for, the catalyst this week we had talked about earlier on. This is the PCE. This is the personal consumption expenditure. The core PCE is what the Fed uses as a measurement when they look at their inflationary data. This is the inflation on the consumer level here. And we'll start with the headline number. And back in August, it went 0.4% increase, and for the month of September, it went up 0.3%. So its year over year went from 4.3% up to 4.4%. Now, we also got the core, and the difference between the two, the headline and the core, is that we exclude food and energy because those are two variables that we have no control over, and they can be very volatile at times. And as we've been seeing of late, energy, both have been going up considerably as we visit the grocery stores and our gas pumps. So let's take a look at the core month over month. So August it went up 0.3%. Forecast is called for 0.2, and it came in at forecast. So its year over year remained the same at 3.6 to 3.6, even though they had a forecast at 3.7%. Now, we're going to get back to this one. We had consumer spending for the month of, or outlays for the month of September. So they spent considerably a bit of money back in August at 0.8%. Forecast was accounted for 0.5%, and it came a little bit higher at 0.6%. So people made less money in the month of September. However, they still spent a bit of money. Then we go to Chicago PMI. This is data, manufacturing data in the Chicago region for the month of October. So September we had a 64.7, and on this index, anything above 50 is considered expansion or optimism. So forecast is showing a dip, like most of the others. We've been seeing some dips in manufacturing at 63.5. However, it went upwards to 68.4, which is obviously very good news. So as you can tell, when you're above 50, it's considerably higher. So this is a very good data rate we're seeing right now. Last but not least, we'll go with the consumer sentiment. This is a survey done by the University of Michigan. We had a 71.4 back in September. It was supposed to remain the same. It had a slight uptick to 71.7, so people are feeling slightly better in the month of October here than they were compared to last month. Now let's go back here. We'll look headline news. Data is actually mixed. The stocks are kind of mixed territory. They've been kind of going in much higher levels at new highs. We had some very soft data out of Amazon and Facebook, so the market was a little mixed on those terms. A lot of the reports have been coming out have been coming in very good. However, a lot of them are also coming in that they're revising their year-end forecast that things are going to slow down. And a lot of that has to do with labor and supply controls, their supply chain. So this is, of course, right now investors know this, but they're not looking at in the immediate term. So, and then next week we got the Fed meeting, FOMC, which they are intended to. Well, it's expected of them to start mentioning the tapering, the plans for tapering. Now, we don't know if they're going to begin like immediately in November or if they're going to start in December. We do have a feeling it'll be this year because they've been kind of stressing that they want to do it this year, and this will probably be something that'll be wrapped up by March. And then later in the year, next in 2022, they're talking about maybe halfway through the year, maybe start raising interest rates. So that will be the new discussion coming into next year. So look forward to hearing that from the Fed here. So in the meantime, let's go ahead and take a look here at the mortgage-backed securities and see what mortgage rates are doing. We were down quite a bit. It didn't have any play off of the PCE early on. We were way down here. We were down like 14 basis points even at one point as I was looking at this. Right now we're about even, which is good news. However, money just simply came out of both markets. Stock market was going kind of negative territory. I think Dow might have been the only one that was a positive when I checked earlier, and this was a negative. So money simply just came out of both markets. I think you're looking at investors kind of repositioning or looking at where they want to move money at, and so they just kind of pulled money at the time, and now money is starting to come back a little bit where they're moving. Now, you may have heard, short-term rates kind of match that of the long-term rates, so we're kind of at a flat level that we saw earlier in the week. About around Wednesday, we saw some the flattening of the curves. So that's something we definitely want to watch, because once we get to that inverted curve, that typically means that we can go into a recession. Usually when that happens, a recession usually happens shortly thereafter, usually within a few months. So right now we're at even levels. Some of those who priced earlier are already starting to come up with better pricing. So that pricing will basically give us to the point where we were yesterday. So where we closed yesterday, I believe we closed down about 11 basis points, if I recall, yesterday on this. So let's take a look at the volatility today. As you can see, we had early on shot way down here. It slowly worked its way back, and it worked its way back again a little bit further. So we're back into levels where we are at basically even from where we left off yesterday. So, which is good news compared to what we were seeing earlier on. Yields, same thing. This 25-day moving average has been tested twice over the last 2 days and been pulled back. Same thing here on the yields. We tested 25-day moving average and has pulled back. We started the day up here much higher, and now we're down a little bit. We're down to about 1.56 currently, and again testing the 25-day moving average. So we'll have to wait and see if we can break up on the yield side, break below it, or hopefully at one point mortgage-backed securities can break back above it and try to work on the 50 and 100-day moving averages. All right, so what does this mean? At this point, mortgage rates, again, some came in earlier on with worse pricing, but are starting to come in with better pricing, or repricing for the better. So those are coming out with later pricing. For the most part, a lot of them are come with mortgage rates that should remain unchanged from what we saw after yesterday's close here. And then, of course, the day is still young. I think maybe we'll get some improvement. We'll have to wait and see on that. In the meantime, if you guys got questions, please feel free to reach out if there's anything I can do for you guys. One other thing I forgot to touch on was the national average of mortgage rates. 30-year fixed at 3.22 and 15 years at 2.61 now. And these, again, are national averages with points kind of built into them. So I guess you could kind of take it with a grain of salt, but at least it gives you some basis to go off when you're talking to different lenders on those programs. These are based on conforming limits as well. All right, folks, again, I'm here to answer any questions we can help you guys out with. We'd love to be able to earn your business. If you guys like these videos, please smash that like button and follow. Greatly appreciate you guys, and you definitely help out the channel when you do those things. You guys have a great rest of your day. Enjoy your weekend. We look forward to see you guys on Monday. Take care.